My greetings to everyone. In the ongoing series of Finance for Everyone, today we have a topic called managing money. Yes, when you talk about money, you talk about cash and you talk about savings. So let us unveil the different horizons of the same. Both cash in hand and money put away for the future are necessary components of a sound financial plan. Now, it is very important to grow your money through investing and pursuing the opportunities for expansion. But it is equally important to have a solid foundation of cash and savings so that you can fall back in case of something goes wrong. And if you don't want to rely on the credit cards or the loans in an emergency, keeping some cash in hand can really help you cover the unanticipated cost and get you out of a jam. The standard recommendations for the amount of money that you should be saved in an emergency fund is between 3 and 6 months worth of your living expenses. The accumulation of the savings, on the other hand, can facilitate the achievement of your monetary objectives and give you a feeling of safety and consistency. Now, it doesn't matter if you are putting money away from a down payment on a house, education of your child, or retirement. Having a very specific saving plan can really help you reach your goals more quickly. The power of compounding interest is one of the primary advantages of maintaining a saving account. And when you put money into an account that earns the interest is added to the balance of the account, which then earns the additional interest. So this effect can have a compounding effect over time, which can significantly increase your savings and help you reach your financial goals much more quickly. However, in addition to the obvious advantages that came with the cash and the savings, there is also a psychological factor to take into consideration. And when you have cash in hand and the savings in the bank, you have a better sense of control over your financial situation and experience less stress related to money. So this has the potential to bring about increased contentment and the well-being in all facets of your life. So to summarize, the liquid assets and the savings serve as a bedrock upon which a sound financial plan is constructed. You'll be able to construct a very secure financial future and accomplish your objectives with the self-assurance if you give these aspects the priority. Now, understanding the time value of money. The time value of money is a fundamental concept in finance that helps explain why money is worth more right now than it is going to be worth in the future. The concept of the time value of the money refers to the notion that a dollar today is worth more than a dollar in the future due to the potential earning power of the dollar. This means because a dollar today can be earned to buy more things than a dollar in the future. So there are several primary reasons why money has a time value, including the following. The first and the foremost is the inflation. As a result of the inflation, the purchasing power of money typically decreases over the course of time. This indicates that a dollar spent today has the potential to purchase more goods than the same dollar spent in the future. So the cost of missing out on the potential returns when you could have made the investments using more current funds is known as the opportunity cost. And if you don't have the access to those funds until some points in the future, you won't be able to take advantage of the potential returns from the investments. So the outcomes of the future events are never completely predictable, which introduces an element of the risk. So if you have money right now, you can just put some of it away from unexpected expenses or invest in something with a lower risk of loss. Now, both of these strategies can help you reduce your exposure to risk. and it is very important to gain an understanding of the time value of money, because doing so enables one to make more informed decisions regarding their finances. For instance, if you are thinking about taking out a loan, you should check to see if the interest rate on the loan is higher or lower than the potential return on any investments you could have made with the money. Now, if it is, then you should probably pass on the loan. Now, in a similar vein, if you are trying to decide whether it is better for you to pay down the debts or save the money for retirement, you will need to weigh the potential return on your investments against the interest that you are required to pay on your debt. You will be able to make more educated decisions regarding your finances and increase the value of your money over time. Now, if you have a solid understanding of the concept of time value of money. Now, let us see the difference between the savings and investing. However, although both saving and investing are very essential steps in the process of accumulating wealth, these two activities are not interchangeable. When we talk about the savings, we mean putting money away for a specific goal, whereas when we talk about investing, we mean putting money into assets with the intention of earning a return on those assets. The following are some of the most important distinctions between the two. Yes, we are talking about the difference between the savings and investing. The majority of the time, people save money in order to achieve a near-term objectives, such as establishing an emergency fund, putting money aside for a down payment on a house, or paying for a vacation. And when you invest, on the other hand, you do so with the intention of maximizing the return on your money over the course of a longer period of time. Now, let us talk about the risk. Putting money away in a saving account is typically viewed as a low-risk activity. Now, when you save money, you typically put it in a saving account or another low-risk account that is insured by the government. Now, if you don't have the saving account, you can also use another account. Investing, on other hand, exposes you to a greater level of risk due to the fact that you're putting your money into assets whose values are subject to change. Now, the other is return. While the rate of return offered by the saving account is typically quite low, the return that could be made through investing could be significantly higher. Obtaining a return on your investments can be accomplished through the purchase of investments like stocks, bonds, mutual funds, and to name a few examples. When it comes to liquidity, the savings account are typically considered to be more accessible than investment options, and in most cases, you won't be subject to any fees, and if you remove the money from a saving account, in contrast to the potential for encountering the penalties, and if you do not withdraw the money from an investment account. And when it comes to amassing the wealth, it is essential to save money in addition to making investments. So, putting money aside each month can really help you meet your short-term objectives and give you a feeling of safety. But investing is absolutely necessary if you want to be successful financially in the long run. Now, establishing a reserve or for unexpected cost. A saving account designated solely for the purpose of covering the unforeseen cost, such as those associated with a car repair, the medical bills, or the loss of a job, is known as an emergency fund. Having an emergency fund is very important part of managing your own money, because it can really help you avoid going into debts or having to make withdrawals from your long-term savings to cover the unexpected expenses. And if you don't have an emergency fund, managing your own money can be very, very stressful, and it is of course very difficult too. So following are some of the steps you can take to build up some money in case of an emergency. The first and the foremost is set a goal. Now, to get started, decide how much money you want to have saved in your emergency fund by setting a specific goal. A good rule of thumb is to save enough money to cover your living expenses for 3 to 6 months, but your goals should be determined by your specific circumstances rather than a general rule of thumb. The next is your start small. The establishing of an emergency fund can take some time, therefore, you should feel as tough though you have to save up to the total amount all at a time. You should begin by putting away a modest amount every month, and as your financial situation improves, you should work to build upon your savings. The next is put your savings first. Include the establishment of an emergency fund as one of the primary focuses of your budget. You should give some thought to automating your savings by arranging for a direct deposit from your paycheck into your saving account, or by arranging for an automatic transfers from your checking account into your savings account. The next is your keep it separate. To avoid giving in to the temptation of using your emergency fund for the things that aren't emergencies, you should always keep it in a separate account from the rest of your savings. You should give some thought to opening a new saving account dedicated solely to your contingent fund. Reassess your situation on a very regular basis, because your needs for an emergency fund may change over time. And it is very important also to regularly assess both your saving goals and your progress. And if you experience a significant change in either of your income or your expenses, you may find that you need to adjust the goal you have set for your emergency fund or increase the rate at which you save. Now, in the event that you experience a disruption in your income or unanticipated cost, having an emergency fund can give you a peace of mind and a sense of financial security. You can set yourself up for financial success and greater peace of mind when it comes to managing your own money if you follow these steps and make it a priority to build up an emergency fund. Now let us talk about the different types of saving account and their features. Now there are a number of distinct varieties of the saving account, each of which comes with its own set of characteristics and advantages. The following is a list of some of the most common types of saving account that you might come across. The regular saving account is the most fundamental type of saving account and is provided by the vast majority of financial institutions, that is banks and the credit unions. Although the interest rate on these accounts is typically low, opening one and keeping it up to date is very simple. The annual percentage yield, that is APY, on these accounts is typically in the range of 1% to 2%, which is significantly higher than APY, that is annual percentage of yield on the standard saving accounts. So they may restrict the number of transactions you can complete in a given month or require a higher minimum balance. but the potential return on your saving is significantly higher with these accounts. A money market account is comparable to a saving account. However, unlike a saving account, a money market account typically carries a higher interest rates and may impose additional limitations on the number of withdrawals or the transactions that can be made. Now let us talk about the certificate of deposits, what we call it as CDs. The certificate of deposits are a type of saving account that require you to deposit your money for a set period of time, typically ranging from a few months to several years. If you want to withdraw your money before the end of the term, you will need to pay a penalty, and you may able to earn a higher interest rate on your money, and if you are willing to lock it and locked up. So the individual retirement accounts, also known as IRAs, are a very specific kind of saving account that has been developed for a purpose of saving money for retirement. Now there are many variations of individual retirement accounts, such as traditional IRA, the Roth IRA and SEP IRA. Now it is very essential to take into consideration your objectives, the amount of time you have available and the amount of risk you are willing to take when selecting a saving account. A traditional saving account or a high yield saving account could be a good choice for you, and if you are looking for a place to save the money that is both secure and convenient for the short-term financial objectives. A certificate of deposit or individual retirement account, that is IRA, might be a better option for you. And if your goal is to save for a long run, by gaining an understanding of the various saving accounts that are available, you will be able to select the one that caters to your requirement and enables you to work towards your monetary objectives. Now coming on to creating a budget and keeping the tabs on your expenses. Creating a budget and keeping a track of your expenses and your spending are two most important aspects of effective personal financial management. Now, creating a budget and keeping the tabs on your expenses, you will have a better understanding of your current financial situation, and you'll be able to identify the areas in which you can save the money, and you will be able to make educated decisions about how to allocate your funds. If you are able to create a budget and keep the track of your spending, putting together a budget and keeping the tabs on your spending can be accomplished through the following steps. First is determine your income. The first thing you need to do is, in order to create a budget, is to determine all of the different forms of income you receive. Now this includes your regular salary, any bonus you may receive, and any form of income. Now make a list of your expenses. The next step is to compile a list of your recurrent monthly expenditure. Now this would include the payment for your mortgage, your rent, and as well as the payment for your utilities, groceries and transportation. Now establish the priorities. After you have compiled a list of your expenditure, sort them in descending order of importance. So this will assist you in making educated decisions regarding the distribution of your financial resources. Now make a budget. Using the information about your income and expenditure, make a budget that reflects your top financial priorities using the information that you have, and be sure to set aside some money each month for both savings and unanticipated cost. Now spending should be tracked. Once you have a budget established, you should track your spending to ensure that you are remaining true to your financial plan and you can keep track of your expenses using a spreadsheet, a budgeting app, or even just a pen and a paper if you want. Examine and modify. Examine your budget on a very regular basis to determine how well you are sticking to it and modify it as required. This will assist you in maintaining your current course as well as making any necessary adjustments to ensure that you are successful in achieving your monetary objectives. You will have a better understanding of your current financial situation and will be able to make more educated decisions about how to allocate your funds. And if you are creating a budget, keep a track of your expenses. So this can assist you in reaching your long-term financial goals by allowing you to save the money and cut down on the debt and the more. So this was all about the overall concept of the savings, investments, cash, and about how you can build your financial expenses using a very important tool called budget. Thank you so much.